Welcome to TheoTrade. This is Don Kaufman. It's December 21st, 2018, and you are watching the TheoTrade Weekend Update. So, in my trading career, and I go back about 20 years, you can kind of remember some of the really specific kind of harsh volatility moments in your trading career, regardless if you made money, whatever your positions were. And again, I can point out a handful of weeks where we're back in 2008 or early in 2009 or really early on in my career when the internet stocks went up in flames, late 90s, early 2000. And I hate to say this, but unfortunately, we just passed through one of those weeks, one of those memorable weeks, one of those weeks where doesn't matter again what your positions happen to be, you're going to remember this. Again, what I want to do on this video is, before we get to a couple of the charts, I want to make a couple of key points. And before anybody starts pointing fingers, it was the Fed, it was the administration, we can go on for a half an hour about that. The bottom line, and the first point that I want to make on this video is what we just saw. And really this last week, it kicked into high gear, obviously, was a complete and utter asset flush. Just to point out, in December, in December, you've got, for example, the Russell down 16%, and the S&Ps are down about 13.4%, and the Nasdaq is down about 14.4%. Ironically, oil, which is just getting hammered earlier this week, it too is down about 15%, and there's nowhere to hide. There's nowhere to hide. Gold is up a whopping 2% in December, and the bonds are up about 2+% in December. So again, regardless of whatever you might think about some of the sell side activity that you just saw, it's a complete and utter asset flush. Effectively, what that means is correlation across the board. There's nowhere to hide. Before I go any further with this, as I was saying, you go back on like this 20-year career, and you think about all those moments inside of the marketplace and some of the volatility that's hit, and there's no question, this is rather unique. Okay, we've been talking ad nauseum here at TheoTrade in 2018 and even late in 2017. Listen, I've come in to 2018 with a chip on my shoulder, a bearish chip on my shoulder. I've been listening to the Fed, and I really don't think that positioning yourself in this marketplace took anything more than listening to the Fed. They told you precisely what they were going to do. But now it's not about the positions that you had on this last week or had on in the last couple of weeks. Now everything is about moving forward. Okay, what can you expect moving forward, and what can you do, all right, whether you're investing or trading moving forward? So in a few moments, when we come into the charts, I'm going to point out again a couple of the risks that are still there. But the second point that I want to make before we go any further into this is one of the risks that really surfaced this week is now we've got to talk about credit risk. Anytime you see the market started to sell off this hard, all of a sudden it's like, that credit risk comes back in. And most people, they're not really all that familiar with what that effectively means. When I say like credit risk, right? I'll give you an example. Junk bonds, have had the largest outflows ever recorded in this past week of trade. What effectively that means is, so the junk bonds selling off like a rock, but the interest rate associated with the junk bonds is skyrocketing. So if you need money and you need to borrow, in a junk bond, which is, again, not exactly the best credit, but lots of companies, of course, are junk. I don't mean the company is junk, but the rating is junk. All of a sudden now you're going to be paying a substantially higher interest rate, which is then sparking, other credit fears. Why? It's just a ripple effect. And it's actually one of the reasons that right now we're actually seeing financials, big financials, they're getting absolutely obliterated in the month of December. They're down about 16%. Specifically, what I'm actually referencing happens to be the XLF, which is the financial sector ETF. It's down about 16%. Again, I'll show you some of what I call kind of credit woes. This is something that in the coming weeks, we have to be extraordinarily careful into watching. All right, so credit risk is in play this week. It had not really been in the last couple of weeks since some of the sell side activity kicked off. But again, a lot was sparked in just the last few days of trade here. All right, the next point that I want to make is for those of you that have a portfolio, okay, you have a 401k, you have an IRA, you got some tough decisions to make ahead of you, okay? If you're still long this marketplace, you just saw the S&P 500 sell off from roughly just round 2,600, and it ended the week just north of 2,400, 200-point move, okay? Just to clarify and quantify, this past week of trade, we were expecting a $65 move inside of the S&Ps. What did we get? Just shy of a 200-point move. Okay, you're looking at 3 deviation kind of territory. Now, would I anticipate some big bounces back to the upside? Absolutely. But I guess, ironically, I was expecting that a little bit this week. You were looking for bounces this week, but it was relentless. It was an asset flush, and I'm going to bring up some problems with that asset flush here in just a moment. But the bottom line with this, with those portfolios, is you have to recognize, I think, that, number one, if you had hedges on, before you remove those hedges, okay, you need to project out 3 months, 4 months, 6 months. What do you think, okay, this market is going to look like 6 months from now? Now, I don't want to put my own bias into your equation, okay, for your portfolio, because that's just, it's not fair, okay? What do we know? What do we not know? Well, we know right now that the Fed ain't got our back, but they haven't had our back now for a long time. What that effectively means is the Fed's going to keep pressure on us, okay? To me, right there, that's it. That's enough, okay? I'm going to have to find ways, obviously, to make money in the marketplace other than just getting long stocks. It's not too easy to find something to buy. Look at this past week, right? You can name, a handful of stocks that were up. Literally, a handful of stocks. Even the commodity products took heat, okay, in again, this last couple of weeks. As I said a moment ago, gold's up a whopping 2% in the month of December. So a big portion of what you really want to think about, again, and that matters to me, is this is one of those memorable weeks. I just want to make sure that people are getting not only just through it, like, right, you're holding a portfolio, I got through it, but you need to start projecting out 3 months, 6 months, okay? One of the things that really strikes me is that yes, the markets are coming down right now, but we're still in the midst, okay, of the single largest stock buyback year in history. 2018 is going to go down. They're going to buy back, okay? It's going to come out to, it's supposed to be about $1 trillion. It's going to come out to about $800+ billion in stock buybacks. And you just saw, again, an asset flush like nobody has seen since the financial crisis. That's disconcerting unto itself, okay? If any of the sell-side activity continues, though, these firms have to stop their buyback program. Why? They're going to hoard cash. They got to go after it. Now, here's the really disconcerting area in the short duration, and I'll show you this in just a moment in the charts. We got a problem. We got a problem with volatility. Yes, the VIX is starting to come up. Yes, the VIX is starting to ignite to the upside. Not that much. The big problem I see is skew. Skew has to do with the out-of-the-money puts versus the out-of-the-money calls, okay? Skew, it's still incredibly low, which tells us, okay, that traders are kind of taking this in stride, and they're still selling out-of-the-money puts. To confirm this, I don't just look at one thing. I don't just look at skew. I don't just look at the VIX. I also looked at the VVIX, which is the VVIX, which is the volatility of the volatility index, was down today. Does that make you feel warm and fuzzy that trading firms are going out there and they're selling volatility, okay, into this mess? It's like nobody is even hedging. And my fear at that point is they're going to have to get the fear of this market put into them before the sell side activity really abates. And don't get me wrong, we could have some wild up moves coming, okay? But this volatility, this is duration volatility. Put your helmet on, because we're in it right now. And again, one of the most memorable weeks in recent history. And this is one that, even a 20-year career, whether I have a 40-year career or 50-year career, I'll of course remember what we just saw towards the December of 2018. With that, let's get to the charts. All right, to a few of the charts we go. We are going to kick this off with a couple of percentage view looks at specifically the December timeframe. Now, what I've done is adjusted the chart to start, of course, on December 1st till effectively right now, which happens to be December 21st, the last 3 weeks effectively of trade. One of the things that I found and why I've been labeling this an asset flush is the market's absolutely uncanny ability to whack almost everything, okay, in identical and correlated percentage terms. What I'm actually saying over here, take a look at the spiders. Now we're going to speed this up a little bit. Look at the spiders. They're down just about 14%. Okay, cruise over to the IWM. The Russell took actually the brunt of it. Exact same time frame. Russell's down just shy of about 17%. Take a look over at the Nasdaq. Okay, the Nasdaq also on some of the forefront of the sell side activity, same time frame. Nasdaq's down just about 14%. Doesn't matter where you go. You want to go to what you believe is the hardest hit. Go to the financials. The financials are down just about 16%. Again, it's absolutely correlated, almost perfectly, right? But we're just looking at the S&Ps and we're looking at the Russell and we're looking at the Nasdaq and we're looking at the financials. What about oil? Because we saw oil get smoked earlier this week. I mean, just again, what you're thinking is like an uncanny move, except that it's right in line with the equity markets. Oil is getting hit exactly in line. Okay. And I look at this, and again, it's complete and total asset flush. And when I said there's nowhere to run to, nowhere to hide, then you cruise over to a product like GLD. Again, we're just looking, okay, at this month. GLD, where is it? On the month, and I think this is critically important, shy of 2% to the upside. Or maybe you look at bonds. I want to run to bonds. Yeah, guess what? Bonds are up 2.6%. There's just nowhere to run to, nowhere to hide. It's kind of, what we're kind of terming, it's the bubble of everything. And across the board, assets are just getting hit. They're just not even being like discriminated against. Hit everything, hit it as hard as you possibly can. And there's so many issues with some of the sell side activity that we've been seeing. And I'm going to bring a couple of those issues to light here momentarily. So enough of the discussion of the asset flush, because for the most part, you get it, right? Markets are down and down big. In fact, if you pull up the spiders now on a year-to-date basis, they're down about 10%. Yes, there's still a week left of trade of this year, okay? But again, it would be hard-pressed to see a year turn around and be positive with some of the sell-side activity that we're seeing. One thing to bring into scope, although the spiders are down 10% on the year, the Russell happens to be down just about 16%. The irony is, okay, 3 weeks ago, the Russell was flat on the year. Now it's down 16%. Last but not least, got to be careful here. The Nasdaq is still outperforming, which effectively means, well, the Nasdaq on a year-to-date basis, this thing could still get served up on a platter in the months to come because it's still the outperformer of that. Keep that in mind if you're ever going to go out there and consider some bottom fishing a couple of stocks. Now, let's spin this around a little bit. Let's actually come in and let's talk specifically about the SPX, because what we saw inside of the SPX, well, this is some big movement. The point that I want to make inside of the SPX is right here. This is obviously this past week of trade. Okay, we were expecting a $65 move higher, or again a $65 move lower. Again, here's the starting point for the week. Where was the starting point? Right across here. It's 2,600. Where did we effectively end the week? Right here at 2,400. Okay, so it's just shy of a 200-point move on a $65 expectation. Effectively, we got 3 sigmas out of this week. We're right on it. Okay, 65 times 3, guess what? That's almost to the penny what we saw in this marketplace. Okay, 3 sigma move. And those 3 sigma moves, that is, people, this is few and far between. One other thing I want to zoom out on for just a moment and kind of bring you into some detail is this, some of the statistics behind this. If you started right here on October 1st and you actually counted each one of these expirations, this is week to week, okay? Right now, what you actually have, and I think this is an important point, you have 6 out of the last 12 weeks. 6 out of the last 12 weeks have actually had breaches of expected move. Effectively, it's a wildly inefficient marketplace when it comes to pricing options right now. They've done a terrible job of pricing options. What does that mean? It means that the option market, okay, is not good right now at handicapping how much the market's going to move. It's something I've just been harping on kind of week in and week out, is that in the short duration, the markets are actually moving more, much more than the options are giving them credit for. However, with that in mind, before I go any further, okay, we're already going to look at next week. Okay, next week, I know everybody, it's a holiday week. Merry Christmas. This is, not exactly a wonderful Christmas kind of cheery video. I get that. But this next week is a big, big move. Okay, how big? In the SPX, we're projecting just shy of a $92 expected move. Now, hold on just a second. First of all, okay, you better recognize that Monday, which is Christmas Eve and holds an expiration, right? Monday is Christmas Eve, holds an expiration. The markets are closing early. It's 1 p.m. Eastern Standard Time. There's a $50 expected move baked into, okay, just a few hours of trading. All right, I'll give that one a pass. You look out 5 days, $71. You look out, okay, the full length of the week, and you've actually got just shy of a $92 move. Why does that matter? You really only have 3.5 days of trading. Last week we saw a $65 move. This next week, bring it. The risk is a coming, people. And now they finally expanded, right, that volatility on these weekly options. So the volatility, it has absolutely picked up. But if we look at the VIX itself, okay, versus some of the carnage that we've seen in this marketplace, you still have to kind of shake your head and think, wow, I would have expected us to be at least at a 40 VIX. At least at a 40 VIX. Now, I'll come back to that a little bit later. You'll notice that I'm not spending time, okay, on individual equity products, because just the fact of the matter is, this is about the entire marketplace. At a time like this, yeah, maybe you can focus a little bit on the financials, okay, which we'll discuss here momentarily. But in a broader sense, everything is correlated. Whatever the S&Ps do, whatever the Nasdaq does, so goes the marketplace. And talking about the Nasdaq, decimated in today's trade, just shy of a 4% move. Again, anything over 3% is what we would term statistically significant. When you start getting 4% moves, you're getting down into the record books. That's the kind of move that we just saw literally today. Now, as I said, I'm going to come back to the financials here momentarily. My bigger concern has to do with HYG. Now, again, this is not something necessarily that I'm jumping out to trade. It's a larger concern for the entire marketplace. And to do this justice, we'll even open up to a 10-year kind of weekly. Why? Because the acceleration of the move to the downside is what's so disconcerting. Right now, we're going to sit on this week. It's going to be the largest outflow, okay, in the history of this product. Okay. Speaking of which, the volume here, nothing less than phenomenal inside of the HYG. Anywhere you look on this chart, you don't see any kind of moves until you actually go back into stuff like, again, the financial crisis. And that's what becomes, again, a bit disconcerting. Now, do we think that we're headed that direction? Absolutely not. But I'm telling you that these credit markets, you have got to pay attention to them, because when this starts to sell off, the damage that's going to be done isn't here and now. It's out in the future. Okay. You are now taking the interest rate of junk and you're making it what? Explode higher. The lower the HYG goes, the higher the yield. Okay. And again, this is some unprecedented sell side activity. $3 move inside of a week is nothing less than hideous at this point in time. So this is where I say now there's some credit woes. Okay. Where is that starting to play out? The financials. It's one of the reasons the financials are just getting decimated. And I have to tell you, the financials, again, no matter what happens inside of the broader market, sooner or later that risk, it always ends up in the financials there. Credit risk is something that we're going to keep a close watch on, and we will keep you abridged of any situations that start to really occur when it comes down to credit risk. All right, but let's switch gears a little bit now. Let's talk about and be proactive in this environment. What are you going to do? What am I going to do? One of the first things I am doing, okay, I'm starting to build a little bit of an inventory. Now I'm going to show you some of my inventory, okay, and this is just inventory that I'm building, okay, specific into these spiders. Now, I'm also building inventory in the SPX, but I'm a strong believer that newer traders, even some experienced traders, okay, don't necessarily need to be trading inside of the SPX. So I'm showing you a little bit of what I term my inventory. What's inventory? You know, a couple of 5 lots, a couple of 2 lots, a few 1 lots, and a partridge in a pear tree. I'm building a net inventory. My delta in this case is almost completely flat. By the way, this is just my spider inventory. I'm collecting about $43 a day with rather minimal margin requirement, only $7,500. What I tried to do in this particular circumstance is this is just groupings of iron condors distributed into multiple expiration cycles, okay, over many, many strikes. It's incredibly important. You have to get this right in the midst of volatility, okay? It's distribution of capital so that, okay, people think I should just place one big iron. Yeah, then all your risk would be here and, for example, here, okay? We got to spread that risk out. We got to distribute capital as far out as we possibly can. The risk graph in this case would never do the trade justice. Why? Because I'm actually spread, okay, through three different expiration cycles in here. And the risk graph kind of is only really one-dimensional. It really shows you depth in one expiration cycle. So it's something to think about. What's important here is minimal directional risk, maximizing theta. I also am starting to just ease into an inventory a little bit inside of the IWM, firing off a couple of trades. Okay, this is what selling premium is really about. But before I go any further, okay, I definitely have to elaborate upon a few of my concerns at this point. I see that the SPX is all puffed up in its volatility. And believe me, okay, that's a $91 move expected for 3.5 trading sessions. So what did I do? I sold a little premium in there because that looks like a pretty huge move. But at the same time that I'm selling premium, I am thinking to myself, I'm like, listen, it's a $91 move, but it's only a 30% volatility. And I can't help, but I told you I'd come back to the VIX. I can't help but look at the VIX and think to myself, and I was talking about this on the video portion, I've been through some pretty serious trading times, and I've seen some wild things occur, but I had never seen a 30 VIX on a memorable week. Never. The VIX is always 40, 50, 60 in weeks like this. Okay? I mean, the memorable times like, August 24th, 2015. Listen, I can rattle off every major volatility event in the last 20 years. But I can't explain why the VIX is at 30. Other than, okay, a lot of people are looking at stuff like, let's go to the SPX again for just a moment. And people look at stuff and they think to themselves, yeah, let's open up option statistics. Look, Don, look at the number of puts that traded versus calls. The put-call ratio is off the charts, okay? They're trading double the number of puts than calls. Yeah, well, guess what? They must be selling the puts, not buying them. Why? Because the volatility isn't that high. That volatility would be a lot higher if they're buying that many options, okay? It's in the spiders. I looked at the Nasdaq, the Qs. Look at the Qs. Double the number of puts trading and calls, except the volatility is only 32%. I looked at the IWM, okay? Double the number of what? Puts trading versus calls. I looked at the financials, okay? Look at the financials. How insane is that? And again, the volatility, though, it's not that high. On top of that, when I said the volatility is not that high, then I looked at the VVIX. That's the volatility of the volatility index. Ooh, a double negative. The volatility index is actually down today. You should scratch your head at that one. What that effectively means, people are coming into the VIX options. They're actually selling VIX options today, right? Use this as a little bit of a contrarian indication, if you will. By the way, you want to see the VIX options? Oh yeah, they traded today, 1 million contracts. Look at the number of calls versus puts. Except when you look at this, you're like, oh yeah, they're buying calls. They must be buying calls. We are going, no, they're not buying calls. How do you know they're not buying calls? Because the volatility is down. Now, to further compound this, if you look at the skew, a lot of people are like, I don't even know what skew is. Okay, I'll go easy on you here. It's the out of the money puts versus the out of the money calls. The skew, okay, it jumped a little bit. The skew is yawning right now. That effectively means we know that they're selling out of the money puts. As a contrarian indication, what that effectively means is these people that are selling premium, they haven't had the fear of God put into them yet. And it's disconcerting. There's a lot right now of compounding risks in this marketplace. I am absolutely starting to sell some premium. Okay, you just saw my inventory. I'm building some inventory in the SPX and other accounts. I'm selling some premium. Okay, but at the same time I'm doing it, I can't help but look over at the volatility and think it's inherently low versus some of the risks that we've seen. The other thing, and I'll leave you with this, I look at a 20-year on the SPX, and that intimidates me. Okay, it absolutely intimidates me because, listen, I've seen this kind of movie before. And we've had 10 years of an up move. We are in it now, all right? And that means the volatility's got a hold of us, and it ain't going to let go. And you need to think about that moving forward. If you're going to sell premium, there's no reason to run out in front of a freight train, okay? Sit back, sell a little premium, use some irons, couple calendar spreads. We'll have a party. Do not step out over your skis right now, or you're going to get your head taken off in this marketplace. As I said a moment ago, people, that's a 20-year monthly, and you haven't seen a candle like that before. Okay? You got to go back on a percentage basis, again, into the financial crisis, and you're still not seeing a percentage move like we just saw in the last 3 weeks of trade. With that, I want to thank everybody for joining us here at TheoTrade. We will be broadcasting throughout the entire holiday season. Unprecedented volatility, we're going to be there for you. Thanks, everybody. Bye-bye.